It starts quietly, not with a crash, not with panic, with silence. A for sale board that's been standing for months, a builder delaying possession, an agent whispering, buyers have vanished, and yet prices are still higher than ever. Feels impossible, doesn't it? Because if demand is fading, why are property prices still climbing? If everyone's nervous, who's still buying? Here's the truth no one wants to say out loud. Real estate prices aren't rising because homes are scarce. They're rising because denial is abundant. Underneath the glossy ads, record valuations, and last chance to own slogans, a fragile system is creaking. And when that system finally snaps, it won't announce itself. One morning, you'll wake up, open your real estate app, and realize the thing everyone said could never happen just did. Welcome to Real Estate Bubble 2.0, the sequel no one wanted, but everyone's trapped in. Why this matters right now. Everyone believes real estate can't fail. It might slow down, but it never really crashes. That belief, more than the prices themselves, is the real bubble. Because underneath, three powerful forces are colliding: rising interest rates, record global debt, and human optimism. And when those three meet, history shows something always breaks. To see what's coming next, we need to go back to the moment it all began, when cheap money turned into dangerous confidence. The birth of Bubble 2.0. After the pandemic, governments around the world unleashed trillions in stimulus. Interest rates hit historic lows, fueling a global boom in housing. People wanted security, a home, land, an asset that felt real. In the U.S., tiny suburban homes sparked bidding wars. In India, property developers sold out in days. In China, even ghost cities had buyers. It looked unstoppable. But what it really was? A collective bet that money would stay cheap forever. Buyers borrowed more. Developers doubled down, using pre-sales to fund half-finished projects. Nobody noticed that the foundation wasn't cement, it was credit. The system beneath the shine. Real estate doesn't break overnight. It bends first, slowly, invisibly. Let's simplify what's happening. When interest rates were 4%, a 50-lakh home loan cost about 30,000 rupees per month. At 8%, that same house now costs 42,000 rupees. The house didn't change, only the math did. That one number shift kills affordability from millions. Buyers pause, sellers wait, deals dry up. But prices don't fall right away because no one wants to be the first to cut. That's how denial disguises itself as stability. For months, even years, prices appear frozen until the silence spreads wider than the demand ever did. The irony of safety. The greatest irony, property is sold as a safe bet. Your parents believed it. You might too. But safety has a cost. You can't sell a flat instantly. You can't offload land like a stock. When liquidity disappears, safety becomes a trap. And that trap is now closing. Because the market's value depends not on cash flow, but belief flow. Banks compare nearby sales to justify new valuations. If one forced sale happens at 20% lower value, everything near it reprices instantly. One nervous seller breaks 10 confident ones. That's how a quiet correction turns into panic overnight. So let's turn this on you. If property prices in your city drop 25% tomorrow, would you buy? Or would you wait for them to fall even further? Would you trust that it's just a phase? Or realize maybe it's the real unwinding? Tell me in the comments what the realistic property rate per square foot should be in your city right now. I want to see how far we've drifted from reality. And if you want more fact-based breakdowns like this, not hype, not doom, just truth, subscribe. Because over the next few months, we're going to track this unfolding in real time. The hidden math behind the hype. Globally, real estate wealth touched $380 trillion in 2025, about 4 times the world's annual economic output. But here's the part no one states. Only around 20% of that value sits on actual productivity. The rest is leverage and expectation. Meaning, the wealth is real only if nobody tries to cash out. That's why real estate feels strong until people start selling. The problem isn't high value, it's simultaneous belief. When everyone's convinced prices can't drop, prices rise. But when everyone silently doubts, no one buys, and still no one cuts price first. That frozen tension delays the crash, but also makes it worse when it comes. The global domino setup. Look around. Central banks have stopped printing cheap money. Rates have climbed. Construction costs soared. Developers with floating rate loans are choking. Institutional landlords, those who bought entire apartment blocks, are now quietly exiting. Homeowners refinanced at record low rates, meaning they can't move or sell without losing their favorable loans. On paper, that looks like fewer listings. In reality, it's trapped liquidity. The market has become a frozen asset masquerading as booming wealth. And when liquidity locks up, it doesn't whisper, it implodes. Inflation versus deflation paradox. Here's where things get weird. Every investor expects inflation to save property values. But in truth, inflation pushes rates higher, which suffocates lending and demand. That's the paradox. Rising prices kill the very demand needed to sustain them. It's a slow-bleeding form of deflation wrapped inside inflation. And every time the government tries to fix it by printing more money, it prolongs the problem, because the cure slowly becomes the poison. The human story beneath numbers. Behind every graph is a person trying to hold on. A young couple paying half their salary just for EMI. A builder delaying handovers, hoping prices recover. A banker praying defaults don't start triggering headlines. We call it greed, but often it's just fragile hope pretending to be strategy. Everyone thinks they'll exit first, but in every bubble, someone ends up without a chair when the music stops. And when that moment comes, it won't look like panic. It'll look like denial. Society and the systemic consequences. When housing becomes a vehicle for profit rather than shelter, societies fracture. Young people stop planning families, rents outpace wages, and entire economies get distorted around the illusion of asset wealth. Real estate becomes less about homes and more about positioning. That's how we end up living in cities we can't afford, surrounded by buildings that aren't really occupied. Wealth pools at the top, optimism runs out at the bottom, and right in the middle, people stop believing altogether. That disbelief is the real contagion. The slow crash nobody sees. So what happens after the music fades? History says bubbles rarely burst dramatically twice. Instead, they leak, slowly. Developers slash prices quietly. Bankers extend new repayment holidays. Governments keep announcing stabilization packages. The news headlines won't say crash. They'll say things like soft landing, temporary correction, buyers cautious. But you'll feel it. In slower construction, empty showrooms, longer listings. That's how crashes sound in real life. Not with screams, but with silence. Bubbles don't need fraud or villains. They just need faith and time. Prices doubled because everyone believed they could. Now belief is fading and math is returning. The end of every bubble looks calm, right before it's not. So ask yourself one last question. If real estate isn't the safest investment anymore, where does safety truly live? Maybe the answer isn't in property. Maybe it's in understanding before everyone else does. Welcome to Real Estate Bubble 2.0. Stay alert, stay curious, because this story isn't ending, it's just beginning. See you soon, guys. Thanks for watching.